Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. Next up on our event schedule is the Planet MicroCap Showcase Virtual on December 6th through 8th, 2022. On day one of the event, we'll be hosting the first ever Stock Pitch World Cup. 6 global areas, 6 moderators, 24 total stock pitches. Joining us to moderate each special session is Maj Swaydan, representing the USA, Paul Andriola, representing Canada, Fadi Diab, representing Australia, Jason Hirschman, representing Europe, and Kelvin Sito, representing Asia. The only way to see the Stock Pitch World Cup is by registering now. And then, of course, on day 2 and 3 will be presentations from microcap management teams as well as one-on-one meetings. Attendance for our event is complimentary for investors, and registration is now open for it. So to join us, please visit www.planetmicrocapshowcase.com. Now, for this episode of the Planet MicroCap Podcast, I spoke with Shree Viswanathan, President and Portfolio Manager at SVN Capital, Stephen Kiel, Founder and CIO of Arquitos Capital, and Keith Smith, Portfolio Manager of Bonhoeffer Capital Management. We did a similar Willow Oak Roundtable conversation back in 2020 and thought I'd bring the crew back together for a temperature check on 2022. I really appreciated everyone's take here, and I think you will too, on what we're experiencing in 2022, how we got here, what's ahead, and why all 3 guests are embracing the idea to one degree or another that the special situation right now is finding growth-oriented firms using value framework. Thank you again for tuning into episode 245 of the Planet MicroCap Podcast, and please enjoy the Willow Oak Roundtable with Shree Viswanathan, Stephen Kiel, and Keith Smith. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. Welcome back to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today is we're actually doing another Willow Oak Roundtable. We did one of these not that long ago, about almost 2 years ago. And it was time to bring the band back together to get everybody's take on the year that is. And I think most people would like to think of it as the year that was, but here we are. It's still 2022, and we want to talk about what's going on. So joining me today, we have Shree Viswanathan, President and Portfolio Manager at SVN Capital. We have Stephen Kiel, Founder and CIO at Arquitos Capital, as well as Keith Smith, Portfolio Manager of Bonhoeffer Capital Management. Gentlemen, thank you for joining me today. How you doing?
Thanks, Bobby.
Great. Thanks for having us here.
It's great to have you. So as I said, I wanted to get a kind of, at least to start, to do a general temperature check on this year in 2022. And then we're going to dig into some topics that I found were really interesting from your most recent investor letters that I think folks should think more about, because I think they're really good topics for our core audience here. So to start us off, Keith, give us your take. How is the year that is 2022 for you right now?
Well, it's an interesting year. I mean, most portfolios, as people know, are down, depending and down various amounts. It's a time definitely of retrenching and rethinking. I mean, I think these times when the market is down is when I know personally I've probably learned more than when the market's up. You learn more from sort of the challenges that happen in portfolios. One theme that I've specifically found very interesting at this point is looking at companies that are growing from sources other than organic growth. Given sort of the dearth of growth in the world in general, and with populations declining and those types of things, you have organic growth is a rare commodity in the markets today, and a lot of times organic growth is priced into the values of companies. And so one thing I've been sort of trying to find are there other areas where companies have historically grown in the past that may not be reflected in the valuations. One in particular is sort of like growth through M&A. I mean, there's pluses and minuses with that. You need to have the right management, you need to have the right process. You need to have management with the right temperament, because it's clearly not an easy process. As through a number of studies have said, most acquisitions fail in terms of creating value. So looking at the ones that do create value is an interesting sort of area. And what I've tried to find are specific companies where they are involved in acquisition aspects of it. So they're getting this organic growth. They've done it in the past and will continue to do it in the future. Also taking a concept or a concept from a book by a guy named John Neff, a very famous mutual fund investor that ran the Windsor Fund through the 1970s, a similar time to this, not exactly the same, with his relatively high inflation. There was shortages. And how did he do? What were some of his best sort of areas for finding companies that did well during that period of time? And one area he talks about are these unrecognized growth companies, which are companies where you can get growth rates, let's say like in the double-digit growth rates, but multiples relatively modest. And what happens in those cases is, what I've noticed in a number of cases is the market does not give credit for future acquisitions. They'll only give credit for what the company has today, and adds some. It does a really interesting, provides an interesting opportunity, I think, for investors. And this was something I sort of observed a few years ago, but really sort of made a larger part of the Bonhoeffer Fund in regards to finding these opportunities. They're across different industries. I mean, there's some in certain industries, but it's a cross section of different industries where this is happening. So I think it provides an interesting exposure for folks that are looking for a different type of. It's clearly a value. The Bonhoeffer Fund is a value-oriented fund, so it's in essence, and some people may call it deep value, but it's definitely a value-oriented strategy that's combined with sort of this growth aspect of it. And the book that he wrote is really good. I'll sort of put it up here. It's called John Neff and Investing. It's one of the classic books that's out there. It's written in the, I believe it was the early 1990s. So it's not necessarily a new book, but it really is a good book. He was like one of the best performing mutual fund managers from, I would say, the mid 70s through the 80s. And he sort of, in the book, sort of goes through and talks about his strategies. And then what I find really interesting is he has a diary in the back and sort of goes through the various times when, over time, what happened. And so you can get an idea, taking a look at, okay, this is real time. Here's some of the companies you looked at. Here's ones that did well. Here's ones that didn't do well. So it's a very interesting, I think, it's an interesting book to read in these times of sort of inflation. We're sort of I think inflation's here for probably similar but different reasons. But in essence, it provides, I think, a nice sort of set of frameworks for people to look at in regards to sort of investment ideas and themes that they can come up with in their portfolios.
Very good. Thank you, Keith. Stephen, can I come to you?
Yeah, absolutely. What do you got?
I thought you were going to pull up your John Neff anecdote.
A couple of things on Keith, on Keith's comments that I want to echo. First of all, excellent book. I remember reading that in the beginning of my investing career. And John Neff is not really a household name, but he was an excellent investor, one of the best performing mutual fund investors at the time, which, including kind of higher fees. So he's a legend for sure. And I do remember an anecdote from the book when I was reading it, where he was like on vacation in Europe, and he was reading a Wall Street Journal one morning, and one of his investors came up to him, happened to recognize him, and came up to him and said, "Oh, I'm invested in one of your mutual funds. It's good to see you're working. You're nonstop working." And the idea is, he's sitting there reading a Wall Street Journal. That's his work. That's the information that he has. There was actually an advantage to get access to a Wall Street Journal, while in Europe in 1982 or something like that. And it just shows the difference between, access to information here in 2022 compared to the 70s and 80s, where he would basically call long distance back to his office a couple times a day and read the journal. And that's what kept him abreast of today's news, which is a little bit crazy. But also to echo Keith's comments about just M&A and let's say interesting things in the market today that I'm looking at, that because of, so to say, dislocations and changes, now we get interesting divestitures. We get some corporate restructuring. There's some interesting bankruptcy stuff going on. There are companies with warrants. There's an end of the SPAC boom that there could be some interesting things there as well. And so it's really a fascinating time to be an investor. All of us obviously wish that performance was a little bit different this year. But first of all, we have a couple more months to go, so who knows what could happen. But these difficult times in the market is when we set up the performance for the future, because this is when we're finding companies that the overall market is not appreciating, and this gives smart investors who are digging deep into these opportunities a time period to accumulate these companies and then have the patience to hold them over the next few years, where we can hopefully see the realization of the actual value. So that's what I'm looking at. It's a lot of similar to Keith, and I'm sure with Shree as well. We're excited about this environment, and we have to dislocate disassociate the actual kind of day-to-day performance compared to the exciting investment opportunities that we're finding that we know will work out over the next few years.
Very good.
Some other interesting things I think that is sort of happening here too is if you look at investment surveys, people are pretty much negative now. So that aspect of it, I think, leads to some interesting opportunities that Steve had mentioned, and I'm sure Shree will go into the same sort of things. But the sentiment is really poor amongst individual investors and just in investors in general. And you just think about the amount of negative stuff that's actually happened now. It's pretty big, right? I guess there's a few more things that could go wrong, but it'll be tough to really find. So I think in terms of events being random over time, there's probably some positive surprises at some point that are going to happen, but who knows when that's going to happen, right? But that's just another sort of observation, I think, from a general market perspective, I think that's out there.
Yeah,
absolutely. So, hey, coming to you, Shree, what's been your general temperature check thus far in this year so far in 2022?
Sure, but before that, and I do want to echo one important point that Keith brought up and Steve reiterated, which is this concept of reinvestment. This acquisitive growth that Keith was referring to is essentially addressing a very important concept in compounding value through reinvestment. I absolutely, that's an integral part of my analysis when I'm looking to deploy capital. I'm not only looking for high quality businesses that are generating high returns on incremental capital, but also have this high reinvestment opportunity. However, this acquisitive growth is an area that I am always a little careful on. And I remember back in the days, Warren Buffett doesn't write like this these days. But back in the day, in one of his annual letters, he referred to this acquisitive growth in his own inimitable style. He was quoting this country singer Bobby Bear, and essentially telling us that the song was about, I've never gone to bed with an ugly woman, but I sure have woken up with a few. And that is what comes back to mind whenever I think about acquisitive growth. But the concept of reinvestment is a very important piece, and I fully agree with Keith on that. The other point that he brought up, which is also kind of illuminating as far as this particular year is concerned, I've seen more recently, I'm sure you have come across this chart. I think it was Bank of America, BFA, which put out this chart recently. Cash held in institutional funds is at the highest level since 2008. When we're talking about 2008 being the great financial crisis, financial institutions were the epicenter of that crisis. And here we are, the individual balance sheets are at an all-time high. Institutional corporate balance sheets are also in a much better position relative to what it was in the past. Of course, because of all the regulatory changes that have happened since the financial crisis, banks, which were the epicenter of that crisis, are in a much better position, well capitalized. I think it's the sovereign balance sheet which has sort of ballooned in terms of debt. That's a completely different problem altogether. And if you sort of narrow it down in terms of the overall economic performance, we have almost 2 full jobs available for every applicant that's looking. And so job scenario is actually well placed. So everything that you have typically seen as the primary driver of crisis in the past is absent in this case. And yet you see significant fear, both from individual and institutional investors, taking cash all the way up to 2008 level, which I think, Steve referred to this, is actually positioning our portfolios, our individual portfolios, exceptionally well in the near to medium term and long term, of course. So that's my take. We'll see what Jerome Powell comes out with later today. But overall, I take the view that, we've been through these types of events in the past. In fact, I referred to it in my mid-year letter. One of my favorite writers is this gentleman, Nick Murray, and he has very eloquently put this in the past. The dominant determinant of real life returns is not investment performance, but investor behavior. People get scared at various different times and run for the hills. That is what is happening, which I think is a significant positive for people like us. Bobby, if
Sure.
you allow me to, I can actually share this interesting chart that I put out in the mid-year letter. Let me see if I can share that.
Okay, here, let me allow your sharing real quick. All right, you're good.
Okay.
Sorry for those who are listening to the audio version. I'll include this in the show notes or in a link in the description so you can see.
So yeah, this is a chart from JP Morgan Wealth Management not too long ago. I thought this was an excellent chart, and so I included it in my mid-year letter. Essentially, it lists year by year, going back to only 1999, from 1999 all the way to 2021, the various different reasons why you could have found a reason not to be invested. And yet, if you look to the far right, the returns that have been generated since then. The blue wiggly line that you're seeing, that's S&P 500. So, for example, in 1999, you had Y2K scare. In 2000, it was the tech wreck, and so on and so forth. 2020 was COVID, and 21 was the Omicron variant. 2006 year is actually an interesting data. It's not a bad year, but Pluto was demoted from being a planet, and that's the only reason.
There we go.
So, I mean, there are, there have been incidents like this, and we will, of course, see more incidents like this in the future. And I thought that would be an interesting chart to highlight.
That actually stood out to me when I was, getting ready for our panel today. Is that chart, and something that you quoted Daniel Kahneman and his partner. I always mess up how I say his name. Sir, correct me when you'll correct me. But you talked about the idea of availability bias in your letter as well, and that describes our and I'm quoting directly from your letter here, where it describes our tendency to use information that comes to mind quickly and easily when making decisions. And you mentioned how this is quite prevalent, especially when you talked about that conversation you were having with your it was a real investor, but you were hiding their identity with Peter, where they were talking about how they were just so fearful of what's to come. I mean,
it's interesting, like you're saying. I mean, the other thing aspect of this, I think that may not a lot of people talk about, but I think is out there, is the chart that Shree put up there is great. Those are U.S. returns, and are probably indicative of most of what I would say are democratic type of returns. If you invest in autocracies, the returns are very different and significantly less. And so I think that's one thing that it's an interesting note, that when people talk about international diversification, sometimes they say, oh, just go invest anywhere internationally. And you have to be really careful. I mean, there's some really good studies, and I can provide that to you, Bobby, in terms of the reference on this. But what they've shown, they've gone back and they've looked at countries that were autocracies versus democracies. They found the rate of return of companies in democracies, this is going back to probably 2000 or even before that, is double that of autocracies. And intuitively, you think it makes sense, but that's actual raw data to say that, okay, if you look at some places where there's autocracies now, or countries that are moving that way, let's say, like, for example, China, there's a reason why these multiples have come down from China. And the real question in my mind is, for them to go back up, things have to improve. If things stay the way they are or continue to go down, and a lot of people rely on sort of this reversion to the mean type of phenomena when it comes to investing, that things are going to revert back to where they were. But you really need to take a look at the dynamics of the cases where the markets have gone up over significant periods of time. Those are primarily democratic countries with capitalist type of systems. So the shareholders get a decent share of the economic profits of the businesses. If you're in a situation where you're in a more autocratic system, where what's happening is the same thing's happening, it's just that the shares of the pie is being as a shareholder, you're not getting the same share of the pie that you would as a Democrat, a shareholder of a company in a democracy. And you just need to realize that. And I think I was surprised at the difference there, almost 2x, but I think it makes sense from that perspective.
Yeah, and we have to keep in mind, I mean, most U.S. companies have some sort of international presence, whether from suppliers or customers or things of that nature. And so, when you want to get access to certain regions or areas, you can often do that through U.S. companies with U.S. laws, with U.S. listings, with all the protective measures in place and information distribution that is more reliable here in the U.S. So, look, I'm primarily a U.S. North America English-speaking investor. Not to say on occasion I haven't taken an opportunity beyond that, but I think there are a ton of opportunities in the U.S. market, and especially if you're a smaller investor on the over-the-counter market, the pink sheets and things like that, where there are voluntary disclosures, even if they're not SEC filing. And some of these companies still go back 30, 40, 50 years, and they, you can rely on the rule of law. And, this kind of veers a little bit into what's going on in Delaware and the Twitter Elon Musk fight, that, this is the foundation of corporate law in these states like Delaware.
Very good. I mean, look, I was going to save this question for later, but I think maybe now is a good time to bring this up. For our, what would you say is the general, what is the general retail audience missing in times like these? Like why does this keep happening? I know we could talk about behavioral biases and we can quote Kahneman and Tversky, over and over, but it just keeps happening, especially, now where it's just so focused on the short term. There's a lot of the, all the noise is coming in. And then you see charts like what Shree just shared with us, where in times where you think that, things are going to hell and they don't, maybe they do in a little bit in the short term, of course, but long term, if you're really thinking beyond, that the world won't come to an end, there's returns to be had. So at least where we exist right now and this current downturn, what are folks missing?
Well, do people have cash right now too? That's the question with inflation and gas prices going up and, real estate, if you're looking to purchase a new home or at least rent, your prices have gone up. So you don't have the disposable cash that you used to have in order to gamble. And when beginning of COVID, we had a lot of kind of gambling, which happens, okay, it's always happened. It happens regularly, but at various times it happens more often than not. And, you have disbursements from the government and you had people with a lot of free time on their hands. And so there was kind of meme stock gambling, which is still occurring, but not to the degree it was a year ago. So I think that's the ultimate question. Do people not only do they have the disposable cash, but do they feel comfortable gambling with it? And I don't think they do as much today.
Well, and I think I think like you said, Steve, that was probably a very good lesson for a lot of people that sort of started out. And I think, Bobby, part of the thing is I think why people feel so in malaise is their exposure to single individual cryptocurrencies or stocks or whatever. A lot of people took a very undiversified approach to dealing with situations, which it entails risk. And if you're not going to do a whole lot of research, that can lead you to really, run into issues. Now, I mean, I think part of it is the Shree's chart showed the one advantage of having like an S&P 500 or diversification is what that really does is you just get the average and that turns out to be okay. But I think people probably got super excited coming out of COVID with just all these things and everybody's looking at their accounts and saying, we're doing great. And then all of a sudden it all turns around and they're not doing great. I think that in a collective approach, especially for the younger people that just started out doing it, right? I mean, the people that have been in the market for 2 or 3 of these cycles sort of personally know what's going on and they can sort of deal with it. But if you're brand new, you think when you go in there, okay, I know this, I'm going to do this, but it turns out that, you're no different than other people. A lot of people have to personally experience that to really learn the lessons. Years
of cryptocurrencies and meme stocks. The vast majority of investors have lost money in those two vehicles over the last 3 years.
But Bobby, I think, I'll take a slightly different angle to your very important question, a bigger picture question, I think. And I'm reminded of this fable that I heard from somewhere. I don't remember exactly who told this, but I hope I don't butcher this. But this was about, 2 dudes walking in the middle of African plains and hearing a little bit of rustle in the background. One guy saying, is that just wind blowing? And the other guy just took off before he could even answer. We're all ancestors of the guy who took off. So essentially what that tells you is the human brain is wired to be, between fight or flight. we are always wired to take flight. And particularly when it is hard-earned money in the financial markets, flight appears to be a very easy approach. But, the last time I checked, there weren't saber-tooths walking in Wall Street. Of course, there are certain greedy people, would like to separate you from the money, but it's not that dangerous. And as a result, I think if we take a patient approach to, at least the way I think about investing is patient approach to high quality businesses that have those features, high return on incremental capital, high reinvestment, run by quality people. And I'll come back to Keith's comment about autocratic nations in a second. If I take that approach with a view on valuation as being a sort of a reasonable valuation as opposed to looking for cigar butt approach, that allows me to take that really long-term approach and not be totally demoralized by what's happening in the market and all the noise that comes out of it. Back to Keith's point about that autocratic nations not having similar kind of returns. So that's absolutely true. One of the important questions I ask is it a business run by honest, competent management teams with skin in the game? I typically look for owner-operator type of businesses. And that plays out well to the benefit of the shareholders, to everybody's benefit, actually, over time. But that's a very classic US, Western Europe kind of a concept. You see that in Hong Kong, China, India, and many other Asian and even Latin American countries. You may see a large ownership interest from the founders or the founding family, and yet your returns may not necessarily be comparable to what you may have generated by a similar company in the West. I think partly it's because, I can speak from at least a couple of examples in India. There was a big software company back in the 80s and 90s. The founder, who owned a big chunk of the company, woke up one day and said, sorry, guys, I've been cooking up the books. It was a great business, phenomenal returns, was audited by Pricewaterhouse and publicly traded, of course. People made a lot of money, but, the point is, outside North America and Western Europe, there is a tendency to use these businesses as a piggy bank. And that eventually comes back to bite, we, the outside shareholders, who are never really 100% informed about what's happening inside. So anyway, fear drives a lot of our decisions these days. We've had the Ukraine war, we've had run up in inflation, potential rate increase, everything else that has developed from those types of fears. That's what is driving what's happening in the market over the last few months. Again, if I'm taking a 5-10 year approach, I see this as a fantastic opportunity. Some of the companies that I own, one of the Swedish companies that I own is Evolution. The company is essentially doubling every 18 months. With no debt on the balance sheet, on a global scale, it's generating EBITDA margins of 70+%. Founders are on the board, and yet multiples have come in significantly. It's now trading at high teens earnings multiple. It's generating north of 100% in terms of free cash flow conversion. So businesses like that get completely thrown out with a baby. And I think it's a matter of having some patience and waiting it out.
What ticker is this, Shree?
This is Evolution AB. The ticker is EVO.
Great.
That trades in Stockholm.
And as Shree said, Sweden is one of the countries that probably has one of the better governance up there with the US and the other in terms of the way that they've done it. And what's really interesting about Sweden is you have a number of companies, Evolution being probably a great example of this, of serial acquirers, really good corporate governance. It's really a good location epicenter outside of the US and UK where that's really happening. But if you put this in historical perspective, those countries, the ones we're talking about, are the exceptions to the rules. For thousands of years, companies were run by families. And as Shree said, the families looked at it as the piggy bank because they owned it. That was what they did. That was what they did for thousands of years. Now we've got a new system that started out in the Netherlands, went to the UK, spread around the world, went to a number of places. So in essence, from a historical perspective, outside of the places that have really been influenced and affected by this Anglo-Dutch type of a system, you still have this system that's been around since the beginning of time when all these companies were owned by the families, and you as a private investor could go along, but you're pretty much just around there for the ride. And if the guy can do whatever he wants, it's not, and the laws in some of these countries are not set up to really even protect you. It's set up to protect the guys that own the businesses. So Sweden's a really neat place to look for companies. I mean, there's a lot of real interesting sort of companies over there. But
absolutely, I would second that.
Sorry, Stephen, you were about to say something?
No, I was just going to pivot a little bit about maybe some of the risks in the market today that have occurred with a couple companies in my portfolio where the stock prices have really taken a big hit over the last few years, and there have been opportunistic then buyout offers. And so there's a big risk here in this environment for take unders, so to speak, where, okay, fine, the stock's down 50% over the last 2 years. And so somebody comes in and makes a 20% premium buyout offer. And oftentimes it's accepted. And so this is something that I have, and I think Keith might have been involved in this company as well, Countryside Partnerships in the UK that's happened to. It's happened to another company in my portfolio as well. And it's very, very disappointing. And that is actually a risk to our strategies that, this kind of patience and let the market realize the value when you have more shorter term investors, more shorter term shareholders involved who are willing to sell out at a premium to what the market is showing, but a big discount to the actual value of the company.
Yep. And you have to be careful. I mean, there's some, like as Steven said, I mean, I'm somewhat pleased in terms of the resolution of the Countryside, because as a result of that, we will get a large equity in the combined business. Yep. But what can typically happen is these things get taken out for cash, and the upside that you basically bought the company for, in essence, is basically going to be someone else is going to get the reward in that. And sometimes you end up with situations where, I mean, this happened to me last year in a company called Cambria Automotive in the UK. There was a group of investors that basically said, we're going to go together. And one guy decided to go off and do his own thing and basically make a deal with management. And therefore the whole management was able to take over the company. The guy said he did it he was looking out for his shareholders. It's like, I mean, come on. I mean, but that's kind of stuff happens. And like Steve said, that's one of the risks of investing in deeply undervalued companies, is someone else can go out there and basically they realize it too. You're not the only person that has this information. They realize it's cheap. And if management isn't of the highest quality, they will, they could be.
Well, and the shareholder base too.
Yeah, you're right.
And if you have, if you have certain shareholders that'll continue to own a portion of it when it goes private, then their interests are not aligned with yours. And this is the nature of the markets today. I think where the shareholder bases generally are more short-term looking in nature, and that is a risk to our strategies.
I've also been seeing a lot of difficulties in M&A. Especially on the smaller side. I know it seems that there's seemingly a bit more action. There have been some microcap takeouts, and you just talked about Cambria, and there's been some others. But at the same time, it's been very difficult getting some deals done as well.
There's definitely financing issues, of course, and not only not to say that there will be indefinitely, but when there's changes in interest rates rapidly changing, and there's uncertainty in the underlying financials. There's supply chain disruptions and other things like that, which affect smaller companies maybe to a higher degree.
You know what actually has been another very interesting thing that I'm not sure how many retail investors have been picking up on, because, when times were good, when I've been talking with CEOs, we just launched due diligence series on Planet MicroCap, is that when times are good, maybe a bit more cash, maybe some of the smarter companies maybe raise a little bit of capital thinking, okay, maybe grow through acquisition, and they're actively looking for stuff. But the going line that I've been hearing when talking with companies in the last, I'd say 3 to 4, 6 months, is everyone's just reinvesting in the business, heads down, focusing on the business, focusing on the TAM that's in front of them, and not even really considering some of what else is out there, just because they know that those companies that might potentially be acquired, either they're going to be asking for too much, or they just can't get those deals done.
Yeah, I mean, two parts of it. I mean, their bandwidth. I mean, if you're going through challenges in your business and dealing with everything today, and the actual financials and business strategy, you don't have the bandwidth to focus beyond that. And then number two, as you mentioned, there are other competitors that there's competitors who may go into bankruptcy in the future, and so it pays to be patient. And if you're the stronger competitor, and you're beating the competition, so to speak, you might not need them. And so I could see, and of course, everything else with you wanting to preserve your cash as a protective measure, and there possibly being issues in the credit market. You can understand why, especially smaller companies might be just on pause for now. I think, again, in the larger companies, divestitures and restructurings are a fascinating thing to look at, not just now, but over the next few years, I think, because, when you have stock prices languishing, activists come in, CEOs want to make changes, and, that often involves spin-offs and closing down certain certain sectors or whatever subsidiaries. So, that's where there really could be some interesting opportunities.
Well, one thing that I've seen in some of the companies I've looked at specifically, and we do own this company, Asbury, it's an automobile dealer, is that you end up with companies with these huge TAMs, and the TAMs are just so big that in essence, it's not, because the dealership business is probably a good example, because most dealerships are owned by private individuals there may be some multi-generational, but there's a lot of people that are aging out, right? I mean, these guys bought these businesses, they came back from World War II, started a franchise business, and they're cashing out. And so they're probably going to cash out in the next 5 to 10 years. So there's going to be this huge window of these businesses that are going to be out there for sale. And I think the smart guys, I mean, like one of the things that Asbury does is really good is clustering. So they'll say, okay, these are the companies we'll set up a cluster in a certain geographic region and look for people that wants to sell to us in that cluster, because the economies of scale and the automobile dealership business are all local. So if you can be the biggest company and have not have the best margins and the best turns. That's exactly what's going on in the automobile business. If you look at a company like Asbury versus like AutoNation, AutoNation's the biggest, okay, but AutoNation doesn't have the same level of clustering as Asbury. So Asbury can have higher turns, higher margins, because all the economies of scale are local. But the business is just gigantic, and so in my mind, that's one way at this point the companies can. So and they'll follow this typical kind of strategy. Well, they'll buy a business, take on some debt, pay down the debt with the business, and then sort of see what's available. If something's not available, they'll buy back stock. And so that's sort of like a virtuous model that can just be, while you're waiting for this. And what happens with these companies is the market, in a number of cases, if the company's viewed as cyclical or not have a whole lot of organic growth, the market will value the companies at really low prices. So management has the buyback option becomes very valuable to them. Now, the buyback option becomes less valuable if the valuations are really high, but the market has a tendency to value these companies on organic growth, not on total growth. And I think that's where you, as an investor and as looking at some of these managers, they can take advantage of that sort of mismatch in the market in terms of the way that they're pricing some of these companies.
Keith, it's funny that you bring up how, TAM sometimes is so big. I don't even ask it anymore on the due diligence because there's, I look at like, what's the point, right? You just get goofy numbers, and also their focus, especially in microcaps, like they more often than not, they just need to kind of focus on one vertical, own that, and then they can start to kind of grow in some other opportunities, or that. Shree, you wanted to add something to this?
My portfolio is much bigger than the traditional microcap sort of size companies. I see opportunities. I see opportunities for acquisitions. I own a company called HEICO, which is an aircraft parts manufacturer. And that's a type of an acquisition I don't mind, or acquisitive growth that I don't mind. Where HEICO acquires targets, but not 100% of them, leave 20, 30, some percent for the selling shareholders, and they remain vested in the combined entity as a result. As Steve mentioned, obviously, as a result of financing issues, not that HEICO uses outside financing that extensively all the time, but they do use debt when available. As a result of that, and as a result of sellers generally viewing this current opportunity as a little less attractive, deal volume has gone down. Now, that's one company in the portfolio that sort of grows through acquisitions. But generally speaking, my portfolio is, organic growth focused, and that's what I generally prefer, anyways. So I may not have as much to add to what both Keith and Steve.
Well, one thing that I think you brought up, and actually all three of you brought up here today, and it's something that Keith pretty much mentioned in his letter, is how it's this changing in the value-oriented special situations where they're out there, but there is now this somewhat shift where you're like, okay, I want to find those businesses that may not be like what I just said, not so much looking to grow through acquisition, but really just have that value framework, but more growth-oriented, right? I think all three of you would agree that that's really where your focus is.
Absolutely.
Right?
I mean, I think I mentioned this once before in your podcast, Bobby, but one country that I continue to like is Poland, where I see tremendous opportunities. Of course, it's a former communist satellite country, and it still has, at least the Western world still has a little bit of a jaundiced view when they look at Poland. But Poland is my biggest non-US exposure at this point. I've got two businesses invested in Poland. One of them I'd like to highlight here is exactly what you just referenced, organic growth. This is Dino Polska. DNP is the ticker. It trades in Warsaw Stock Exchange. Phenomenal business. It's essentially a 4,500 square feet grocery store. And it's growing at a rapid clip. Rapid is 28 to 30% growth per year, both in terms of number of stores as well as in terms of top line. And again, a business that doesn't rely on debt to grow, doesn't rely on acquisitions to grow. Owner still owns 51% and is the chairman of the board. Poland has certain unique features. Unlike most of the countries, more people live in rural and small town Poland than in bigger cities. And that plays well into this company's strategy of opening up stores in these rural areas. So, you can, unlike, for example, Walmart, which started with a focus in small town America, but took 22 years to become free cash flow positive. Dino Polska is already free cash positive. They're using internal cash to redeploy, to reinvest into new stores. And so you can still find opportunities like this, or definitely both within the US and non-US, with all those features, owner-oriented, high returns, high reinvestment, and so it doesn't rely on acquisition per se to continue to put up that kind of number.
Very good.
Oh, and so it's like as Shree had said. I mean, there's one company I want to mention here that we just bought in our portfolio that is similar to that. It has relied somewhat on acquisitions, but it does have a high return on equity, and it's a Berry Packaging or Berry's Plastics. So in essence, it's a plastics company in the U.S. We own it. It's growing. I would say historically, it's grown really well. I mean, if you add in the acquisitions and the other pieces, it's grown 18% per year over the past 5 years and 28% per year over the past 10 years. I think it probably can grow at least 10% per year going forward. But again, the company has some perception issues because it's in plastics and people don't like plastics, but their focus is packaging. When you think about packaging is a key aspect of most consumer products. Most of their sales are to consumer products and to medical type product industries. Those are two really great industries where packaging is a key aspect of when you think about consumer products that you buy in the store, all of them have a really good packaging aspect to their business. So this company, and it's right now it's selling for 7 to 8 times free cash flow. It's got the great historical growth we talked about and a potential and continue to going forward. The headwinds, I think, which may change as you got this anti-plastics ESG thing, but I think eventually that will actually sort of change and turn around. But that's an example of a company it's not a sexy business, it's not a high-tech business, but it's just a business that's just going to grow, a solid growing business as one of as John Neff talked about, sort of these unrecognized growth companies that if it just grows in the low teens % going forward, you start out and going in valuation at 8 times free cash flow. But the key thing behind these businesses, I think that's how my process has sort of evolved over time, is looking at what are those growth drivers, and are those growth drivers, what are the KPIs for those, and are those growing and tracking those. So it's combining, sort of saying, okay, it's different from a traditional deep value, but it's adding some additional aspects of it, of diving into the business and understanding what the growth rates are, and just making sure that they're going to grow at least as much as what it's been in the past, maybe if not a little bit more, or what you think that's going to be. In this case, we're sort of assuming a deceleration, which could be conservative, but if it continues going forward at higher numbers, and that becomes even more a bigger margin of safety. The other aspect that this business does, it has this LBO feature, so it'll buy a company, pay down debt, buy a company, pay down debt. The same thing that Asbury does. It buys a company, pays down debt, but if it can't find a business, it's gotten bigger over time. So its targets, but it still only has about 20% of the TAM, so it has 80% left. Top 3 businesses have 20% of the TAM. They probably have maybe 10% of the TAM. But if they can't find a business, which is what can happen as you get bigger, then they just buy back stock, and the market treats them as a cyclical. So in essence, they can just buy back stock and it becomes very accretive. So I mean, right now, selling it like a 7 times free cash flow yield, they buy back stock. They're buying back their stock at 8, at a 13%. They get 13% return on buying back their stock. And so from that perspective, it's an interesting. The one thing you do need to be concerned about these companies buying back stock is it's the terminal value, right? I mean, where companies run into problems is if they're buying back stock and the terminal value is less than the value today, they're wasting money. But if you buy back stock and you think the terminal value is going to be higher, then it becomes accretive. But that's sort of like a pattern I found in a number of the companies that I like, where they'll borrow money, take an acquisition, and have a historical record of then basically paying down the debt, doing another acquisition, the debt will go up, going down debt, and then when nothing's available, buy back stock. I mean, I've seen that. It's probably a common sort of model. I think 4 to 5 of the companies we have in the portfolio, but I like that when I see that sort of that sort of situation in a company.
Absolutely. By the way, not to go off on a tangent, but we said that we'd probably be recording at the time that there would be the Fed announcement, and yeah, we got it. Raised by 75 basis points again.
Yeah, I facetiously was going to ask you, Keith, what effect this interest rate.
Well, the interest rates for these levered companies, it would have the effect as you'd expect. A lot of them are challenged, but again, I think as long as you believe in the model, the companies are doing well. This just becomes, they can buy back stock at a cheaper price, right? I mean, if you're looking at buying this business for the long term, one thing you've got to do is you need to make sure that they've got their coverage is significant enough, and they're not going to run into distress. You know, a lot of these companies like Barry's rated BBB, they have 6 times coverage. So I'm pretty sure that the company isn't going to run into financial distress. And so a company like that, what's that?
It's a keyword in my question was facetiously.
Yeah. But yeah, no, I mean, I think the interesting thing about these companies is, you know, levered companies are ones that are getting hit really hard. But again, I think a lot of these are indiscriminately sold off. And that really plays to the companies that have this card of buying back stock. And unfortunately in Europe, for whatever reasons, a number of companies don't like to buy back stock. And I think that really handicaps them versus, let's say, a US competitor that's willing to do that, because the US competitor, if they really understand the value of their business, can really, in essence, provide some leverage to the shareholders buying the shareholders of the stock. It really adds a lot over time. Because I mean, you see these companies where the share count's gone down 50, 60% over 10 or 20 years, and you're just like, wow, you know, it's just, and it's added that it just can be a really nice combination if you can do that. But like I said, hopefully companies in Europe will feel more comfortable with this over time. I think it may have been it's just more of a historical precedent. They just don't do it. But the one thing that clearly I think American companies will do is they'll buy back stock if it's cheap.
Yeah, I agree. European companies, I find to be more comfortable paying dividend, which is actually a lot less attractive for the eventual investor because of the tax impact. And but in, you know, whatever the case may be, most European companies are comfortable just paying a dividend as opposed to buying.
Well,
I think partly it's also because when you require them to buy back stock, particularly the way you put it, Keith, being aware of the terminal value and being able to buy it back at an attractive price relative to intrinsic value, I feel like they fear that we, the investors, require them to be more like investors that they're not comfortable with. And so they want to be operators, and just paying a dividend, they don't have to think much about paying a dividend. And that's what allows them to remain patient with the entire business. But I agree, it's a dividend disease is a problem that's a little bit more prevalent in Europe than here.
But there is a case to make if you do buy dividend. Like, for example, if you look at some of these oil and gas companies, they're creating a lot of cash flow today. I really agree with the philosophy of them paying it mainly in dividends and not in buybacks, because if your terminal value is going to be shrinking over time, buying back stock is a very risky thing to do, because you can lose a lot of money that way. It may be better to what I think the smarter oil and gas companies I've seen have sort of done a balanced approach, but they've tilted it more towards dividends, because we know there's going to be a terminal value there, but we just don't know how much it's going to be. And how much do you want to bet your company that it's still going to be, especially in oil and gas, because it's got such a wide variance of what can happen there. I mean, if you like, for the companies, I think that Shree invests in, the higher quality businesses, I think everyone could agree that their terminal value is going to be bigger. And so buybacks make a lot of sense. But when you're uncertain, I think that's where dividends make sense, but there doesn't seem to be a distinction between the two in a lot of cases. But
absolutely. All right. Well, I think we're getting close to, our allowable time here. So I think I want to try and close this out, because I think, listen, there's so many different rabbit holes we can keep going on. We can talk about how, another hike can affect things, but I figured let's do our closing takes, thinking longish term, I guess. Right. I try on these pods, I try not to do like the, all right, and then, what do you think for the rest of 2022 going into 2023? But, if for your I want to know from your mindset, how you define long-term to be, how are you positioning yourself? So, Stephen, I'm going to go to you first.
Yeah, well, first of all, at least we won't lose another planet this year, so I'll end in that. I mean, no matter what happens this year, we have to count that as a success.
I was worried about Saturn personally.
Yeah. You know, certain. I don't know. Is it a planet if it doesn't actually have, I don't know, like a core? You know, if it's all gaseous. Anyway, what am I doing?
I know you're setting me up, but I won't take the bait.
Yeah. You know, for me, I'm looking for companies as usual, but with smart management, but who are really taking advantage of the current opportunity, whether it's through strengthening their own business and taking market share, or whether it's opportunistically buying back stock, or whether it's making opportunistic acquisitions. And so those are the areas that I'm looking at, the companies that I'm looking at. I'm size agnostic, but there are a few out there. The watch list is growing. I've been busy doing a lot of research on these watch list companies. And I think these are the companies that really, if it's something you can look to buy during these market dislocations that you can hold for the next 5 to 7 years. And you're buying it at a depressed at a depressed price, and also there's some upside uncertainty, which is a positive. There's upside uncertainty as to modeling something out over the next 3 to 5 years because of the qualitative decisions that smart management is making right now. So I think it's an exciting time. The watch list is growing, and I think now is the time for smart investors to build the foundation of their portfolio over the next 3 to 5, 7 years.
Very good. Shree?
Sure. Actually, I haven't changed anything in terms of investment criteria or the type of businesses I'm looking for. It's still, I'm still looking to get a positive answer to the following 4 questions. Do I understand the business? Is it a high quality business? Is it owner operated, preferably? And is it available at a reasonable valuation? And in fact, I've added only one new company to the portfolio so far. I'm looking at a couple of different European companies. Not sure when I will pull the trigger, but so far I've added only one new company, and that's in the US. But I take this, again, Bobby, if you don't mind, allow me to present this one more chart. Let me see if I can show this. So this is from the book Atomic Habits. Okay, this is a nice little chart, the plateau of latent potential. On the x-axis is time, on the y-axis is results. Essentially, what this tells you is the longer, whatever activity it is, in this case, portfolios and investments, the longer you can remain invested. Look at that curve that's shooting through to the right and top. There is a period of valley of disappointment, which is what I've gone through over the last 9 months. But my view is, if I stick to this mantra of getting those 4 questions answered positively and stick to high quality businesses. These are, as I mentioned, Evolution, for example, or Dino Polska. These are businesses that are generating terrific returns with significant reinvestment opportunities. They're not looking to grow through acquisitions, and so I kind of eliminate that potentiality as well. And what it needs is patience from my side. What it needs is, it doesn't mean that I'm ignoring everything else that's available in the market. I'm keeping a close eye on what's becoming more attractive. And I'm happy with what I own and continuing to look at a couple of different newer opportunities. So patience is what I would prescribe.
Very good. I like patience. It's good. Keith?
I would say the same thing. I mean, I think one thing that kept on going through my mind when we're talking about the number of concepts here is we have a good amount of exposure in South Korea. South Korea, I think, has a lot of sort of the latent potential that Steve has mentioned. There's a lot of conglomerate companies there, and the management teams in Korea are finally realizing the government has provided incentives. The companies are realizing that they can get some additional value from doing a number of these creative type of activities. And I think it's going to start to happen. And once it happens, I think it's just there's going to be a lot of real interesting situations over there. The other thing they do have is they do have a basis in sort of Western thinking in terms of the way that they do governance, and the government has sort of encouraged that, and they're moving more towards, because all companies over time, you transition from the family run type of businesses to a third party run or basically owned type of business. And that transition, the various stages of development. Some countries are just starting out, some are completely towards third party ownership, which is a lot of it's in the United States and other countries. Korea is at a place, I think, that's moving at least towards that direction. A lot of countries really aren't, or they're moving back, and it becomes uncertain. So that's what gets me excited there. But I think overall, trying to find businesses trying to find growth outside of, it's almost like it's an interesting compliment, I think, to Shree's approach, trying to find businesses where growth is outside of organic growth. So I think the two strategies probably work good together, in the fact that trying to basically be able to identify those businesses. They clearly have different sets of KPIs, different sets, the way that management looks at things and stuff like that between the two approaches. But I think they both can be successful. The one thing I've noted about a lot of these businesses that consolidate, if you look at their historical charts, you see a lot of them going up and to the right. And what that tells me is that the market is not anticipating the growth in the stock price. If the market had anticipated the growth in the stock price, it would go up and then be flat, right? But the market consistently underestimates the growth in the company's cash flows and the value over time. And that's what sort of creates that sort of stair step. And I think you see that amongst companies that are doing relatively well, is that what investors are taking advantage of is the underestimation of that growth potential in the businesses. And that's what we're trying, I think, as modern value investors, I think that's what we really need to include, which I think all of us are doing now, including growth as part of the process. I mean, as Buffett had said, growth and value are connected at the hip. It's just a matter of, it's not as growth or value. It's just incorporating that into the process of what you're doing. And it can be misleading buying just a bunch of low multiple stocks, because in essence, now, if you look at most low multiple stocks, most of them are there for a reason. And the reason is there's no growth, or it's declining growth. And those can be very risky situations to get involved in. So that's, I think, what I currently say. I'm excited. There's a lot of opportunities out there, I think, as Steve and Shree also have sort of shared. I think it's a good time to either be invested or stay invested or continue to be invested. I mean, I think the negative things are things that, that may happen over maybe the next, 6 to 12 months. But if you look at historically, the market, betting against the market growing has never been a winning strategy. It really, you've lost a lot of money if you've been in cash, or if you've tried to physically short the market over a long period of time. So
for sure. I think that's a great place to end it, guys. So with that, where can people go and find more information for each of you, both your website and social media? So Keith, I'll come back to you first on that.
Yeah. So we're at bonhoefferfund.com. I'm Twitter KDS at Bonhoeffer. That's my Twitter handle, and you contact us either way would work for us.
Very good. Shree?
Yeah, my website is svncapital.com, and Twitter is SVN Capital.
Steven, close us out.
Arquitos.com, ARQUITOS, and you can find me on Twitter, Stephen Kiel, KIEL, and I'd love to interact with you there.
Very good. All right. Well, guys, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And look forward to our next update.
Thanks, Bobby.
Appreciate that. Thanks for having us.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.